Crypto markets continue to unravel under pressure from worsening economic conditions globally as well as central bank moves. Is there more pain ahead for crypto participants? Benjamin Stani of Matrixport joins in to talk about how to navigate these choppy times. Benjamin, thanks for being here.
Thanks for having me back.
Now, major cryptocurrencies are trading at levels last seen in 2020, and per Fidelity's director of global macros, the OG of the crypto world, Bitcoin, is undervalued and oversold. Would you agree?
Yes, so what we've seen over the last couple of days is that crypto markets have been under immense couple of pressure, just like any other risk assets. Tighter monetary policy around the world is creating a really difficult backdrop. The Fed's 75 basis point hike, the first time they've done this in over 25 years, and them continuing to remain hawkish, certainly impacting our asset class. Now, if you combine that with issues in the crypto space where major institutions are experiencing stress and a liquidity crunch, and voila, you get that heavy selling pressure. In fact, Bitcoin retrieved back to and even broke 200-day moving averages, as well as the peak of the last cycle. Both were considered very strong resistance levels. If we're looking at fundamentals though, if you look at the number of BTC addresses holding meaningful assets, that's an all-time high. Hash rate is a record high, and so is lightning capacity. So to answer your question, most metrics, BTC looks oversold, while the fundamentals remain robust. That, however, doesn't mean that we can't go any lower from here, because what's driving prices now is forced selling and liquidation. So what I would recommend is being nimble here. Don't use leverage and just stick to your dollar cost averaging strategy.
We have seen pressure build up on the institutional side with high-profile margin calls coming in, even as MicroStrategy CEO said they have enough collateral to pledge on a Bitcoin loan. What do you make of the long positions being liquidated?
Forced selling is one of the main reasons that it's driving us lower. And it becomes self-reinforcing the lower prices go. That creates more selling pressure and extends onto borrowers that use crypto as collateral. Why is that so dangerous? Because even if one person blows up, that has this cascading liquidity effect. Now, MicroStrategy, I believe, they said their liquidation price is as low as somewhere in the 3,000 to 4,000 range of Bitcoin. That means we're still quite a bit away from them being liquidated. But many other major players are more risky. Celsius has been the most high-profile one, and we can actually see on-chain their MakerDAO loan where they've deposited rep BTC as collateral. Their liquidation price there is around 13K now. And I believe many smaller players out there are much worse off than them. So while we don't know who's insolvent yet, that has led to liquidity drying up in a similar fashion like in the 2008 global financial crisis, where banks had stopped lending to each other because nobody knew who's still solvent.
Well, leverage and derivative products are often considered signs of a maturing market. But in case of crypto, could these products be its undoing?
I think our industry is still very early in the stages of financialization, and it's true that the financial unwind of over-leverage is exacerbating the current downswing. But I would argue this is actually more due to weaker risk management by some players than a flaw in the system. Lending under-collateralized or uncollateralized is a very risky business, and we're painfully getting reminded of that now. What we do know is that crypto is probably one of the last true free markets, and on-chain data can actually allow us better transparency in terms of assessing financial risk. And I firmly believe that the development of more sophisticated financial products, especially derivatives, is not just inevitable, but is ultimately a positive trend, because these products ultimately can help us reduce volatility in the long run, and lower volatility is a prerequisite for further mainstream adoption.
Benjamin, thank you so much for joining in with your perspective as always.
Thank you.